Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you, the viewer, to form your own opinions and make your own financial decisions. Today is Tuesday, December 28th, 2021, and this is Blockhead Traders Weekly. In this week's episode of Blockhead Traders, we're a little bit off pace our normal release schedule due to the holidays, but I wanted to take a look back at a special trade that I made with Progressive Insurance. It's a covered call trade, and I think there's a lot of lessons that can be learned from it. But first, I want to give a shout out, link in the description below, to our free Discord channel. You can hop in there, tell us what you're trading, tell us what you want to hear about. Additionally, you'll find a link to thetagang.com/sprocket888. That's where I post each and every trade that I make, the good, the bad, and the ugly. So let's get to this week's episode of a covered call strategy that I most recently deployed on Progressive Insurance. I want to call this out. It happened to have been with Progressive Insurance, but this strategy could be used for all kinds of underlyings and doesn't necessarily need to be Progressive Insurance. The entry points and exit points are kind of irrelevant. We're just going to use it as a talking example. And so what we have here is I have some trade motivation with Progressive Insurance. And so what you see down here is the 1 year chart back from when I made the trade. I took the trade on November 22nd. And really my goals and why this was showing up as my motivation is Progressive Insurance has a historically large end of year special dividend. So this is called out separately from their quarterly dividends. They award it annually towards the end of the year to shareholders of record towards the end of the year. So I knew this was coming. I kind of wanted to collect this special dividend, and I wanted to be in the stock prior to the announcement of the dividend. Additionally, they do have decent quarterly dividends, not amazing, probably nothing that I would stand alone to hold them just to get the quarterly dividends, but it's a nice added bonus that if the special year-end dividend didn't really pan out to be what I thought it was going to be, they still have a quarterly dividend that they do pay. And lastly, the chart is largely horizontal. And so, as you know, with premium selling, you're basically banking on theta decay. And what that is basically the time value of the option that you sold is slowly bleeding away off of the option. So you can buy the option back later to close it out. So those were the primary factors of the play that I wished to deploy. So what did I do? Like I mentioned, it was a covered call play that I deployed here. And some of the key tenets of that are, one, I needed to own the shares. So in order to collect a dividend, you have to own the shares. So that takes out the poor man's covered call option, because in a poor man's covered call, you don't own the shares. I wanted to basically increase my probability of profit. What I mean by that is if I just buy the shares outright, it's a 50-50 shot whether those shares are going to go up or going to go down. So to tilt the probability of profit, I needed to collect extra premium from those shares. And the best way to do that would be to sell a covered call, or basically sell a call against the shares that you own. Now, I didn't really want to get assigned on this particular underlying because I didn't know when the special year-end dividend was going to be paid. So I didn't want to set the call strike too close to the money, which is where I normally would sell a covered call, is closer to the money strike, because normally I'm more inclined to want to get assigned to basically make that profit on assignment and collect the dividend. In this case, I didn't know when the special dividend was going to come, so potentially I might have to roll this play into another month, depending on when it was awarded. So the contract that I was opening was for December 17th expiration, but if the end of the year dividend was going to come after that date, I would likely need to roll that play into January, collecting more premium to make sure that I could lower my cost basis and still be a shareholder at the time the dividend was declared. What I did was I really watched this thing to find the best entry point. And so right here, there's a zoomed in chart of my trade time. And what I did was I had called out a couple of levels here. We have a level at around 95.63 and a level down around $90. And so what I was looking for is I wanted to pick up the shares at a lower level, or basically when the stock had pulled back to around the $90 mark. And I got in right here on this candle that you see here, which happened to be November 22nd. Now, once I'm in, I wanted to lower my cost basis, like I mentioned, increasing the probability of profit. So I wanted to sell a call that was out of the money. Now, I wanted to make sure that my call had a higher probability of not getting an early assignment on it. And so, being the upper bounds of my strike or my levels here around $95, I said, you know what, I'll go ahead and sell a $95 call, thinking the likelihood of reaching that and exceeding that significantly before expiration is probably low. So remember, looking at this, 95 was a level that I called out. All of this stuff to the right actually didn't exist when I made my trade entry. And so looking historically, the stock really struggled to kind of stay above that 95 mark. So to me, the 95 was an appropriate place to place your call strike, where there was still decent premium and the likelihood of assignment was lower. It was around a 25 delta when I put the trade on in November 22nd. So as you can see, as we approached, we got this really big pullback right here. And that was kind of a trigger for me. It set off some of the alarms where I was looking for a decent pullback on PGR to make that entry. Because remember, this lower level identified around 90 is really where I wanted to start buying in. Because remember, in a covered call, I have to buy at least 100 shares and then sell a call against it. And so I wanted to make sure that I was probably buying closer to the bottom of a particular swing. And so I was fortunate to see this drop as a big pullback and say, okay, let's see if this 90 level calls out a support. If it does, let's enter. And we got this bounce off of this 90-30 mark. And in this bigger candle here on the 22nd, I went ahead and entered my 100 shares. And from there, it was just a matter of waiting for the special year-end dividend to be announced. At the same time that I entered these 100 shares, I went ahead and sold the 95 strike for 64 cents. So I was able to basically lower my cost basis from 91.44 by an additional 64 cents. Fast forward a bit as time passes and the special dividend was finally announced. The dividend was $1.50 a share. So remember, I'm holding 100 shares, so this would be $150 in special year-end dividend that I would get to collect for holding the shares. And the ex-dividend date was actually 12/17. This is the same day of my options expiration. Now, ex-dividend date is basically the first day that the option or that the shares trade with no obligation to pay the dividend, which means you needed to be a shareholder on 12/16 in order to get that special dividend. And so what I have in here zoomed in is the final few days before expiration. So right here on this last candle, that was the candle on December 17th. That was when my options expired. And as you can see, this call out, this purple line was the previously identified 95-60 line that I had on my chart. Remember, my call strike was 95. And so as we're approaching this expiration date, I'm in the money. And this was a little worrisome to me because I really wanted to collect that $1.50. The likelihood of somebody exercising that option early is pretty great, because if they exercise that option prior to December 17th, then they hold the shares and they collect the dividend. So you have to be careful whenever you sell calls, because you have what's known as early assignment risk. And what that means is there can be extenuating circumstances, largely around dividends, where the call holder, remember the person you sold the call to, might actually want those shares, and it might be worth it for them to exercise their call early so they can hold the shares for the purpose of collecting a dividend. And so as you can see, I'm teetering on in the money. And even if I was out of the money, because this is so close to the strike and the dividend is $1.50, it might make sense for somebody to do an early call assignment even at 93.50 on the stock price, because with the $1.50 dividend that they're going to collect, that would push it to the 95 strike. So it's kind of a game. You have no idea if you're going to be early assigned. Assignments are randomly chosen, but the risk and the probability of getting assigned early increases the more closer to the money you are and the deeper in the money you are. It also didn't help the fact that the option's expiration was just a few days away. So the closer to expiration, again, the increase in probability that you're going to be gotten early assigned. So what do I do? Now, what I chose to do was to do what's known as a roll. Okay, so that is buying back the option that I currently have sold to close it out and then selling another option that's 1 month out in time. What this allows me to do is collect additional premium because the option that I'm buying back has almost no theta decay left in it. And so I can purchase it back for a cheaper price. Now, the option I'm selling that's 1 month out still has a bunch of theta in it. And so the difference in those two prices are what I can collect as additional premium. And additionally, what that does is it pushes that expiration date out a month. So the person that's buying that call from me is going to have to think a little bit harder if they want to give up 30 days worth of that option just to collect the dividend. And so what I did was decided to try to roll this out 30 days to, one, give me more premium that I can collect just in case I get early assigned. And perhaps, maybe, just maybe, I won't get assigned because the expiration will be so far away. The holder of the option would choose not to exercise it early, and I would collect that $1.50 dividend. And as you can see, when I made that roll from December to January, I did it just 4 days before expiration, but I was able to collect 90 cents. That's $90. Now, not quite the $1.50 that I was going to get from the dividend, but not too shabby either. So even if this person then goes to make the assignment to me the day before expiration, they have to give up all that premium that they paid for that January expiration. Sure enough, just days after I made that roll, some positive news came out with Progressive and the stock shot way into the money, up into the over $100 a share mark. How did it pan out? Let's recap here. This is the overview. On November 22nd, I basically sold a covered call where I bought 100 shares at $91.44, then sold a call at $95 strike for 64 cents in premium. On December 10th, they announced the special year-end dividend was to be awarded to any shareholder holding shares on December 16th. As we were approaching in expiration week, it was very clear that my option was going to be teetering at right at the money, most likely, given that it was trading above $95 just days prior to expiration. So I decided to roll that expiration on December 13th out 1 month to squeeze a little bit more premium out of that option and potentially give me the opportunity to still hold those shares on December 16th prior to the payout of the $1.50 dividend. However, it did not work out, and I was assigned on December 16th, as it was pretty likely when that stock made such a rally deep into the money that it was time to call that thing away at $95 and collect the dividend for the person that bought the call from me. And on 12/17 was the option's expiration. So what does that mean for me? I line item each of the transactions in this trade right here. November 22nd, I basically paid $91.44. That was how much I had to pay to get the 100 shares. I turned around and collected $64 in premium because I sold that call. Come December 13th, I rolled that into January, collecting another $90 in premium. Now, the call that I sold was at $95, which means the person that exercises it will then pay me $95 per share in order to get my 100 shares. And so you can see on December 16th, I was assigned at $95. I bought in at $91.44. You add all of these up and you can see that I brought in a profit of $510 on this trade. Now, you might think, that's not so much. But let's put this into context. That is essentially a 5.6% return on the capital used in less than a month. So I basically paid $91.44. I collected premium, and then I sold at $95 from November 22nd to December 16th, less than a month. That is a 5.6% return. I hope that gives you a little bit of perspective on the types of techniques that you can use when you get into a covered call situation. And like I said, the difference between a covered call and a poor man's covered call is in the covered call, you're actually entitled to any dividends or distributions as a shareholder because you are a shareholder. And the call that you have sold helps you to collect additional premium on your shares so that you're making money no matter if this stock goes down or up, right? So, this thing could have gone the other way. Instead of up to over $100, it could have gone down, and I would have still collected the $64 in initial premium from what I sold. I would have collected the special dividend of $1.50 a share, and once I had expired on December 17th, I could have then sold another call against my shares, as long as it's above my cost basis, to basically collect more profit and hope for assignment later. So, my backup plan was to basically keep holding these progressive shares and constantly sell call against them each month until I got assigned away. So my end goal was assignment. Ideally, I wanted that assignment to come after I took the collection of the special dividend. But in this case, I was able to collect premiums and the cost difference between where I bought in at and where I sold my call strike for assignment. Still, I was able to net a 5.6% return. And if you look at the probability of profit here, you'll find that it is much more not a 50-50 coin flip because I had these other income opportunities within this trade. So I hope you found that somewhat helpful to talk through an example of a covered call. If you want to hear more, if you want to ask me questions about this, again, link in the description below to our Discord. You can hop in there. You can ask myself or any of the other traders these type of questions. We do this every single day, month after month after month, and we would love to answer your questions. There really is no such thing as a dumb question that you can come in there and ask. Hope you guys all have a great holiday coming up. Hope you guys enjoy some time off from your work, your day jobs, and I hope you can dabble a little bit in the markets. Remember, think outside the block.